Have you ever wanted to be a part owner of a successful business? Imagine owning a slice of your favorite coffee shop, or a piece of that tech giant you admire. Well, investing in the stock market allows you to do just that. And the best part? Some companies share their profits with you. These profit shares are called dividends. Dividends are like getting a bonus for simply being a shareholder. They're a way for companies to reward investors for believing in their growth and success. Think of it as getting a thank you payment for keeping your money invested with them. It's a win-win situation for everyone. In the following sections, we'll delve deeper into the world of dividends. You'll learn how they work, why companies pay them, and the benefits and drawbacks of investing in dividend-paying stocks. So buckle up and get ready to unlock the secrets of dividend investing. Let's break down what dividends are in the simplest terms. Imagine you own a lemonade stand. You're doing great. The lemonade is a hit, and you're making a good profit. Now, you have a choice. You can reinvest all the profits back into the lemonade stand, maybe buy a bigger stand or new flavors, or you can share some of those profits with yourself, the owner. Dividends are similar. When you buy stock in a company, you become a part owner. If the company does well and makes a profit, they can choose to share some of those profits with their shareholders. That's you. This share of the profit is called a dividend. Dividends are typically paid out in cash, but they can also be paid in additional shares of stock. Think of it as a bonus for being a loyal investor. The more shares you own, the bigger your share of the dividend payout. It's a great way to participate in a company's success and earn passive income from your investments. Now that you know what dividends are, let's understand how they work in practice. Companies announce their dividend payments in advance. They set specific dates for these payments, much like your regular payday. First, there's the declaration date. This is when the company announces to the world, "Hey, we're paying a dividend." They'll announce the dividend amount and the date it will be paid. Next comes the record date. To receive the dividend, you need to be a shareholder on this date. Imagine it as a snapshot day. If you own shares on this day, you're on the list to get paid. Finally, there's the payment date. This is the day the actual dividend lands in your brokerage account. It's like payday for investors. You can choose to spend it, reinvest it, or save it. The choice is yours. You might wonder why companies bother paying dividends. Why not keep all the profits for themselves? Well, there are several good reasons why companies choose to share their wealth with shareholders. Firstly, paying dividends is a sign of financial strength and stability. It tells investors, we're doing well, we're profitable, and we're confident about our future. This can attract new investors and boost the company's stock price. Secondly, dividends can attract income-seeking investors. Many retirees rely on dividend income for their living expenses. By paying dividends, companies can attract a loyal shareholder base looking for regular income. Lastly, dividends can indicate a company's commitment to returning value to shareholders. It shows that the company is not just focused on growth, but also on rewarding investors who have put their trust in them. Section 5. Dividend yield, your easy way to measure returns. Now let's talk about dividend yield. This is a fancy term that simply means the return on your investment in the form of dividends. It's calculated as a percentage and helps you compare the dividend payouts of different companies. The formula for dividend yield is super easy. Dividend yield equals annual dividend per share divided by current share price, then multiply by 100. For example, let's say a company pays an annual dividend of $2 per share, and its current share price is $50. The dividend yield would be dividend yield equals $2 divided by $50, then multiply by 100, which equals 4%. This means that for every $100 you invest in this stock, you can expect to receive $4 in annual dividend payments. Pretty neat, right? Dividend yield is a handy tool for comparing the income potential of different dividend stocks. However, remember that a higher dividend yield doesn't always mean a better investment. It's essential to consider other factors like company performance, growth prospects, and overall market conditions. Section 6. The upside of dividends, more money in your pocket. Investing in dividend-paying stocks comes with several advantages. Let's explore some of the key benefits. Firstly, dividends provide a source of passive income. Who doesn't love extra cash flowing into their account without lifting a finger? Dividend income can supplement your salary, help you achieve your financial goals faster, or even fund your retirement. Secondly, dividends offer some insulation against market volatility. Even when stock prices fluctuate, dividend payments can provide a cushion for your portfolio. Knowing you have regular income coming in can make market downturns less stressful. Lastly, dividends have the potential to grow over time. Many companies increase their dividends regularly, rewarding long-term investors with increasing income streams. This can help you build wealth over time and stay ahead of inflation. Section 7. The downside of dividends, what you need to know. While dividend investing offers numerous benefits, knowing the potential drawbacks is essential before diving in headfirst. First, high dividend yields can sometimes be a red flag. If a company pays out a large portion of its profits as dividends, it might have limited growth opportunities. Always research why a company has a high dividend yield. Second, dividend payments are not guaranteed. Companies can reduce or eliminate their dividends at any time, especially during tough economic times. It's crucial to invest in companies with a solid track record of dividend payments and strong future prospects. Lastly, focusing solely on dividends can lead to a poorly diversified portfolio. It's essential to consider other investment factors such as company performance, industry trends, and overall market conditions. Section 8. Real-world examples, dividends in action. Let's look at some real-world examples to illustrate the power of dividend investing. Consider companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These companies have a long history of paying and increasing dividends, rewarding their shareholders for decades. Take Coca-Cola for instance. This beverage giant has been paying dividends since the 1920s and has consistently increased its dividend payout for over 60 consecutive years. Imagine the wealth you could have accumulated by holding Coca-Cola shares for the long term. These examples demonstrate that investing in companies with a solid track record of dividend payments can lead to significant wealth creation over time. Of course, past performance is not indicative of future results, but it highlights the potential of dividend investing. Section 9. Dividends, a smart choice for your portfolio. In conclusion, dividends can be a valuable addition to your investment portfolio. They offer a way to generate passive income, cushion your portfolio against market volatility, and potentially grow your wealth over time. When considering dividend stocks, look for companies with a solid track record of dividend payments, strong financial performance, and a commitment to returning value to shareholders. Remember to diversify your portfolio and not solely focus on dividends. So there you have it, dividends demystified. Now that you understand the ins and outs of dividend investing, you can make informed decisions and potentially reap the rewards of sharing in a company's success. Happy investing! If you found this video helpful, don't forget to like, subscribe, and share. Happy investing!